Now, if you've been following the financial news for the past couple of months, you've probably seen this guy's face plastered all over the place. And if you're on financial Twitter all the time, the way that I am, you've probably seen a bunch of memes about this guy's money printing powers. Now, while Jerome Money Printing Powell has played a large role in the recent market recovery that we've seen, there's also been other factors that have led to one of the most remarkable recoveries the stock market has ever seen. With everybody stuck at home not being able to work, a lot of people have turned to the stock market to look for ways to make money. And this is something that we can see with the recent trend in Google searches regarding the stock market. Now, looking at this chart of Google Trends that goes all the way back to 2004, we see that stock market related searches have peaked during this pandemic and have absolutely dwarfed the number of searches even during the 2008 recession. Now, with this massive influx of new investors and traders entering the stock market, as well as the Federal Reserve and the US Treasury inserting trillions of dollars into the US economy, we've seen the stock market make one of the most remarkable recoveries in history. After dropping 35% in just 1 month, the market was able to come back 47% and actually end up being green on the year. Now, if you're a new investor, this is probably very confusing and you're wondering how is it possible for the stock market to make such an incredible recovery when the economy is in shambles. And that's why in this video, I'm going to be going over what is going on in the stock market, and I'm going to be doing that by first going over this current state of the US economy. Second, I'm going to talk about the role that the US Treasury and the Federal Reserve have played in this market recovery. And finally, I'm going to give you guys some strategies that you can use in order to protect yourself against another potential market downturn. Now, as always, you guys should stick through the entire video because I think a lot of the research I did is going to be very interesting to you, and it's going to help you piece together what is currently going on in the stock market. How's it going, everyone? Aaron here. Welcome back to my channel where I give you guys simplified, rational investment analysis in order to make the best investment decision for yourself. Now, as always, please like and subscribe if you enjoyed this video. I put a lot of time and effort into these videos to make sure to bring you guys the best content possible. So I hope you guys enjoy it. And if you like and subscribe, it's really going to help me out and it's going to let me know to make videos like this in the future. Now with that, let's get right into it. Now with the coronavirus situation over the last couple of months, we've seen major US metropolitan areas turn into absolute ghost towns. Now this means that people aren't able to go out and shop at small businesses the way that they used to, and it's led a lot of small businesses to go into bankruptcy. In addition to that, a lot of these small businesses don't have enough money to continue to keep their employees on payroll, so we've seen the unemployment rate jump higher than we have in the last 70 years. Now this chart actually doesn't show exactly how high the unemployment rate is. Currently it's actually above 25%, and just for comparison, during the Great Depression, the unemployment rate peaked at 24.9%. Now why the unemployment rate is so important for the US economy is because US GDP is driven by personal consumption. You can see up here that 70% of the US GDP is driven by personal consumption. So when people aren't employed, they're not able to spend the way that they used to on goods and services, and this leads to a drop in US GDP. Now when you compare that to a country like Singapore, where only 45% of their GDP is driven by personal consumption, since they're a more trade-based economy, you can see why an increase in the unemployment rate creates a much worse situation for the US economy than an economy like Singapore. Now this is exactly what we've seen in the last quarter, with GDP dropping 4.8% after just 1 month of economic shutdown. The first quarter from January to March saw a 4.8% decrease in US GDP. Now when you compare that to the 8% drop that we saw during the 2008 recession, it's very dramatic since this only takes into account 1 month of the economic shutdown. And it's going to be very interesting to see this quarter's GDP data come out, and I expect it's going to be even worse than that 4.8% drop that we've seen, given the unemployment rate numbers and that we know that 70% of the US GDP is made up of personal consumption. Now, there's this exact scenario that caused investors to panic and sell during the month of March, which led to one of the quickest downturns in the US stock market that we've ever seen. It fell a total of 35%, and if you're watching the market during this period, you'll know that multiple circuit breaker halts where the market fell so quickly that the Securities Commission was forced to pause trading on all stock exchanges. Now, if you're wondering why the stock market only fell 35% compared to the 60% that we saw during the 2008 recession, that's where we have to start talking about the US Federal Reserve's response and the US Treasury Department's response. Now going back to Jerome Powell, he is the chairman of the Federal Reserve, and in that position he makes a lot of the decisions regarding the US monetary policy. Now, if you think of the US as one big business, the Federal Reserve is essentially the bank for that business. Now, the Federal Reserve has a couple of mandates, and they were formed in 1914 in order to influence the US economy through monetary policy, and one of their prime mandates is to keep the inflation rate at 2%. And the reason why the inflation rate is one of their primary concerns is because businesses aren't able to make decisions if the inflation rate is very volatile. So they want to keep the inflation rate as stable as possible in order for businesses to be able to make long-term decisions and be as productive as possible with their assets. Now, the Federal Reserve has 3 main levers that they're able to pull on in order to influence the US economy. The first is through interest rates. And this is what we see up here in the first graph. And you can see that after 2008, the Federal Reserve was forced to push interest rates down to their zero lower bound, which is between 0 and 0.25%. And the reason why they do this is to stimulate spending. Since inflation is around 2% and the interest rate is below that 2%, the Federal Reserve is essentially paying you to borrow money in order to stimulate the economy. And now they kept that going until around 2015 when they started to raise the rates again. However, during this incident with the coronavirus, they've had to shoot the interest rates all the way back down to the zero lower bound. And you can see at the bottom left that the Fed has pledged to keep the rates near zero until full employment returns. And now the second lever that the Federal Reserve has is to conduct open market operations. Now that's just a fancy way of saying that they're buying or selling debt within the open market. Now you can see to my left here that the Federal Reserve's balance sheet has increased from $4 trillion all the way to $6.5 trillion. And they have stated that they're willing to go all the way up to $7.5 trillion and even above that in order to stimulate the US economy. Now essentially what they're doing is devaluing the US dollar in order to stimulate spending. And this has very severe long-term consequences. However, given how drastic the impact of the coronavirus has been, Federal Reserve Chairman Jerome Powell said he's going to worry about those problems later in the future, and his focus is currently on helping the US economy recover right now. And when you hear people talking about how he's printing money, this is what they're talking about, is that they're printing a bunch of money in order to buy a bunch of the debt that the US Treasury Department is creating. And on top of buying government bills, they've also started participating in purchasing junk bond ETFs, which is another reason that you've seen the economy jump back so quickly, because the Federal Reserve has essentially bailed out the companies with very unstable debt by purchasing junk bond ETFs. Now, the final lever that the Federal Reserve has is to issue statements. Now, issuing statements might not seem like a big deal, but actually it provides a lot of stability to the economy, because what business people care about is being able to make long-term decisions. So when the Federal Reserve issues statements like you see down here, where they have pledged to keep interest rates near zero until full employment, this gives businesses the ability to make long-term decisions in terms of how much debt they're going to take out, because they know what actions the Federal Reserve are going to be taking. Now, during this coronavirus impact, we've seen that the Federal Reserve has actually used all three levers. And what they're trying to do by using all three levers is to stimulate the economy and force people to invest in the stock market, because now that the interest rates are at zero, the US dollar is being devalued, and they're issuing statements that they're going to keep interest rates at this level. They're making the opportunity cost of not investing extremely high, which is why you've seen the stock market fly up so high so quickly, because a lot of investors have realized what they're doing. And unlike in 2008, where the Federal Reserve had to wait to assess the impact of the financial collapse, in this situation, it was pretty easy for them to understand what was going to happen to the economy. So they were able to act very early. And that's why you saw the stock market reverse so quickly and so dramatically. Now let's take a look at the role of the Treasury Department in terms of what's happening with the stock market. So the US Treasury Department is a part of the US government, and their mandate is to maintain economic prosperity. They manage the IRS, they manage public debt, and they manage the currency levels. They work very closely with the Federal Reserve, however, they aren't connected. And the Treasury recently borrowed $3 trillion during this last quarter in order to help stabilize the US economy during this coronavirus pandemic. Now, if we take a look at the US debt to GDP, we see that before the coronavirus, US debt to GDP was at around 105%. After this pandemic, US debt to GDP, after the Treasury has borrowed $3 trillion, has skyrocketed to above 120% to its highest levels since World War II. It's going to have very severe implications in terms of the inflation rate for the US economy, which is what we're going to look at after this. Now, finally, a lot of people think that the US is owned by foreign interests. However, if you take a look at who owned US debt in 2018, we see that only around 30% of US debt is owned by foreign investors, while the rest is owned by American investors and American entities. So let's take a look at what has historically happened to the US inflation rate and how that's impacted stock prices. So if we take a look during the 1940-1950s period, we see that inflation at the time when debt was very high was uncontrollable. And the reason why is because there was so much money coming into the US market that it wasn't able to handle it, and inflation was out of control during that period. However, you see after around 5 to 10 years, they were able to rein in inflation and keep it relatively low, between 0 to 5%. And then once again, we saw inflation come back in during the 70s and early 80s. And the reason why that happened is because that is how the US is able to pay back their debt. Now, what inflation does essentially is it makes the debt cheaper, and it lowers the country's debt to GDP ratio. And the reason why is because while the debt level will stay the same, inflation causes the GDP to rise at an increasing rate, which in turn makes the debt to GDP level drop. So this is likely something that we're going to see in the future, because the US debt to GDP level currently is unsustainable, and we're probably going to see them allow inflation to come back in so that they can increase the numerator, which is GDP, while keeping the denominator same, in order to lower the country's debt to GDP levels. So now if we take a look at what happened to the US stock market during this period, you can see that right after World War II, during that period of very uncontrollable inflation, stocks weren't really able to grow that much, and they just kind of bounced around and stayed flat for around 3 years. After which, once they were able to rein in inflation, you see that stocks grew extremely quickly. However, during the 1970s is when the inflation came back, and that's when we saw Paul Volcker make a historic decision to increase interest rates all the way to 17% in order to get rid of inflation. However, you see during that inflationary environment, stocks didn't grow at all. And this is something you're going to have to keep in mind if you see inflation starting to creep back, is that stocks don't perform well during inflation, and actually all assets don't perform well during inflationary environments. So you're going to have to employ specific strategies that work during those kinds of environments. And one of those strategies that works is actually value investing. So now that we understand what the Federal Reserve and US Treasury Department have done, what that historically has meant for stock prices, now it's time to take a look at some aggregate market valuations in order for you to understand the price risk and to know whether you should be buying, selling, or holding your stocks at the current moment. So the first one we're going to look at is market cap to GDP. Now this is also known as the Buffett indicator, and essentially what it is it takes the aggregate market cap value of the US stock market and it divides it by GDP. And generally, if the market cap to GDP ratio is within 110 to 90%, that means the market is fairly valued. If it's below that, it means it's undervalued, and if it's above that, it's overvalued. Now, this alone shouldn't inform your investment decision because, as we can see looking at these charts, the market can remain irrationally priced for extended periods of time. So just looking and saying the market cap to GDP is high doesn't mean that you should be selling your stocks, but it should be telling you that the price risk in the market is currently high. Now, the next one we're going to take a look at is the CAPE ratio, otherwise known as Shiller PE. Now, CAPE stands for cyclically adjusted price to earnings. And what the CAPE ratio does is it smooths out the price to earnings ratio for the stock market by taking the market cap and dividing it by the 10-year average of earnings. Now, you can take a look at this graph below, and we see that the CAPE ratio isn't as high as it was during the 2000 tech bubble. However, it is very similar to stock prices right before the Great Depression in 1929. So from looking at these two aggregate market value metrics, we can see that the price risk in the market is currently very high, and it's why you saw the market react so sensitively and strongly to the demand and supply shocks we saw in March. Now, knowing this, let's take a look at the best options that you have in order to protect your portfolio. Since the price risk is so high and the economy is in such poor shape, we know that there's probably a good chance that there's going to be another market downturn in the future. So the first option that you have, and has the best tax implications, is to buy deep out of the money puts as portfolio insurance. Now, I'm not saying to make 20% of your portfolio puts, that's way too much, but around 1 to 3% of your portfolio being deep out of the money puts is going to protect you from any downside risk because the return potential on puts, and deep out of the money puts especially, are very high. And the reason why this is so good in terms of tax implications is because you don't have to sell any of your current positions in any stocks, and you're able to roll any of the profits that you make from those puts into your current holdings. So for that reason, buying deep out of the money puts is one of the best long-term strategies for protecting capital during market downturns. The second is to set stop losses. Now, if you're not comfortable with buying puts, then you can simply set a stop loss in order to protect from any unexpected market downturns. And the third is the most risky, and that's switching to cash or investing in gold. Now, investing in gold isn't necessarily risky, and I would actually recommend it given there is likely going to be an inflationary environment in the future, and gold historically has performed well during inflationary environments. However, switching to cash is a little bit more risky because now you're taking on the opportunity cost of not being invested in the market, and you should be relatively certain that you're going to be deploying that cash within the next year. So that does it for this video. I hope you guys found it useful. As always, like and subscribe if you enjoyed this video. I put a lot of work into these videos, and I really hope you guys found them helpful. And as a reminder, I'm not a financial advisor. These videos are for entertainment and enjoyment purposes only. But I do hope you guys found some value in them, and I look forward to making my next video for you guys. Have a great week.